After you've discovered the path of financial independence, you quickly get exposed to so many different viewpoints and opinions about money. Some good, some bad, and just some flat out ridiculous. You learn that so many people have opinions on how you should handle your money. That is especially true with social media and television, that it's hard to separate the money truths from the money myths. But in today's video, we're going to tackle 5 money myths that you need to be aware of so you don't make financial mistakes that's going to keep you from achieving financial independence. Let's start with the first money myth, and that is that money makes you happy. Obviously, that's just not true. Sure, the more money you have, the easier it will be to afford certain things in life and can make life a little bit more comfortable. However, without discipline and control, the more money you make could very well make you less happy. There are studies that show that peak happiness can be anywhere from $75,000 to $100,000 for an individual. So what does this mean? Basically, once you start making above $100,000, there are not going to be many things out there that you're going to buy that will bring you a sense of joy, a sense of happiness, and ultimately, I would say, a sense of fulfillment. Now, I am a big believer in trying to get higher income so that you can save for retirement, give to the needy, give to different charities that you care about, whatever that case may be, and also spend the money how you want to. But I do think that objective, and I would say obsession of trying to get so much money starts to become a little bit unattractive in my own eyes if it's taking me away from time with my family, taking me away from the time that I have to do certain things I love in life. For me personally, what matters to me at the end of the day is how I spend my time with my family, spend my time doing the things I love with the people I care about most. And there are many things that I can do without money. So yes, money is an important tool to be able to afford certain things in life, but it doesn't ultimately bring happiness to us. The next money myth is that you need a credit card. I'm going to quote one of the more famous personal finance gurus, Dave Ramsey, who says that a credit card is the cigarette of the financial world. Now, this metaphor may be a bit extreme. I get it. But what I've learned is that there is no reason why you need to sign up for 10 different credit cards. I would say just have one. I used to be on the fence of, hey, I'm going to live by the Dave Ramsey principle and not have any credit cards at all. But after talking with my wife, of course, I learned that yes, having a credit card sometimes is a good thing because it's going to help you build credit to be able to buy that house that you may not have been otherwise eligible for without any good credit history. But I would still say that you can do more harm than good with a credit card. So even though I haven't owned one in about 5 years, my wife still does. And we typically use that for her work expenses that she's able to reimburse herself that rather quickly. But I would say that if you do have a credit card, please don't use it frivolously. Make sure that you assign it to a task, assign it to an expense like a phone bill or a utility bill that you know that you're going to have to pay each month where it's not going to change too much. So that way you can automatically pay that credit card bill off and you won't carry a balance. I really like how Dr. Jim Dahl of the White Coat Investor refers to credit cards. He calls them a convenience card. Think of it as a convenience card. You don't have to have a credit card. You don't even have to use your credit card all the time, but you can use it as a convenience. That makes a lot of sense when you have that perspective of how you may use credit cards. The next money myth is that financing is the only way to get a car. Now, this could be far from the truth. Not to mention that financing a car is way overpaying for something that literally loses value the instant you make that purchase. Get a used car and pay cash for all of it if you are able to. This goes for leasing a car too. Don't even think about leasing. Just don't do it, plain and simple. Now, I will say that some people can only get a car if they finance it. And I remember being in that position. I remember when I was 23, my younger sister was 19 and she wrecked the only car that I had. Thankfully, she walked away fine. She wasn't too hurt too bad. But unfortunately, I only had $1,000 in my savings account. But I had to do what I had to do. I went to CarMax with $1,000 in my savings account and I financed the car. Yes, that wasn't the best choice, the best ideal choice that I could have made at that time, but I literally had no method of transportation other than bumming rides off of my friends to get to work and get back home. So I totally understand that if you do have to finance a car, that's the choice that you have to do. You have to do what you got to do. But one wise thing that I did do was pay off that car note fast. If that's something that you can work yourself towards, trying to pay off that car fast, then go ahead and finance a car knowing that you're going to be making extra payments to try to get rid of that car note as quickly as possible. The fourth money myth that I want to address is that you have your whole life to save for retirement. Saving for retirement is not something you wait to do at the age of 30 or 40 or 50. You need to start as early as possible and start letting that compound interest work in your favor. In the FI, the Financial Independence, and the FIRE, the Financial Independence Retire Early communities, guess what? People in those communities are saving and investing 30 to 50% minimum of their income towards retirement. They're saving, they're investing that money. And I read and listen to podcasts about people who invest more than the 50%, which is wild to me, but I get it. Trying to save 30% is a huge task, but start with what you can. Maybe 5% towards retirement, maybe whatever the match is in your 401k at your workplace. But the key is to get started. And as you learn more about the FI movement, the financial independence movement, investing and saving, and the benefits of using index funds and ETFs that are passively managed versus those investments that are actively managed, and the benefits of using index funds over single stocks, then you can start to feel comfortable and start raising and increasing that amount of money that you're going to be investing. And you don't have to get too complicated by having so many different kinds of investment accounts. I think I do a pretty good job of keeping it simple with my 401k at my workplace, my own individual IRA. Also, my wife has her own IRA, and HSA that the family all has, right? We have one HSA, health savings account is what that stands for, which I will talk about in a future video. So make sure you subscribe to this channel so you don't miss out. Also, we'll be opening a taxable account soon, something that we haven't done yet, but that is in our plans to do so hopefully this year. And one other account that we do save and invest in is a 529 plan for our children. Obviously, that's something that, parents would like to do for their children, and there's nothing wrong with having that account as well. And I would say that anything else is just more work and more excessive. And I'm not sure if having any more brokerage accounts or different types of savings accounts is going to be worth the trouble of trying to manage and just build that into our retirement portfolio. The ones that we have, I feel, are sufficient for now. And if that changes, I will definitely let y'all know on this channel. Now, this myth is one that has become so popular. It's that a traditional brick and mortar bank is the only place to have a savings account. Now, I used to keep an emergency fund in a savings account with my local bank, but this all changed once I learned about online savings accounts that offer higher interest rates than the ones that I'd be getting at the big name local banks. I wasn't even earning 0.5% on my savings account at my local bank. So back in 2018, we opened an American Express high yield savings account, and we started to learn more about these online savings accounts. And by the way, there are so many out there. Sometimes it can be a little bit overwhelming, but if you're interested, I do try to cover as often as possible some of the best online savings accounts, some of the best high yield savings accounts available to you. I try to do that about once a month or every other month. So make sure you subscribe and check that out. And I'll link a video in the description for you to go check that out. But having an American Express high yield savings account was a great experience, but now we're actually with CIT Bank, and that has been a great experience as well. We're just getting a better rate than the one that we were getting at American Express. So online savings accounts can be a better and more profitable option for you to be able to store and save your money in. Plus, they're FDIC insured just like your big name banks are. Now, to learn more about high yield savings accounts, you definitely want to check out the video on the screen. I'll see you over there. Peace.